Hello, everyone. Welcome to the quarterly Diamond Trends webinar. My name is Krawitz. I'm a senior analyst at Rapaport within our information services division. I want to thank you all for joining us out of your busy schedules. I appreciate it, and hopefully I'll have some value to give you in today's webinar. I'm going to speak for about 45 minutes to an hour, and then I'll open the floor to some questions if you have any. You can put your questions in the Q&A tab of the Zoom application, and I'll address them at the end of my presentation. So we're going to be looking at this question of whether we're in a bubble or not in the diamond market. It's something that's been thrown about in the last few months, month or two, including by myself, that we've been sort of throwing out this loose term, that maybe we're in a bubble, which suggests that the uptrend is not sustainable, but maybe it is. And so during the course of my presentation, I'm going to do two things. Three. Our goals are threefold. First is to understand the state of the diamond market in the context of supply, demand, and prices, which is kind of a sort of a flagship theme of our quarterly get-togethers and our quarterly webinars. That's really the focus of what we want to achieve here. And then I'm going to present, within that context, I'm going to present two conflicting scenarios that are currently playing out. That one suggesting that maybe the market is becoming a bit overheated, and the other suggesting that it is sustainable, that there is room for further growth in the market. And then finally, I'm going to spend a little bit of time comparing crises, comparing the 2008 downturn to the 2020 crisis that we've just come through, and how do they differ, and what can we learn from them, and what it means for the recovery. And that will also give, I think, a bit of insight as to whether the market is in a bubble type of situation or not. And my job is to present scenario. I'm not coming to any conclusions, although I think you might suggest from the tone of the presentation what I might think. But really, I'm not giving any forward-looking statements, particularly on pricing. It's very clear. It's very important to make that point. Is that I'm not giving any predictions about polished prices, and I'm really just giving the scenario of how we see the market at the moment. And I'll leave it to you to draw any conclusions that you might come to. So before we get started, I would like to hear from you, and sort of to get a feel of how everyone in the market is feeling about this bubble question. Do you believe that the market is in a bubble that is not sustainable or not? So David, who is one of our project managers at Rapaport and is helping with the technical side of the webinar, David, if you could put up the poll question for people to answer that question, that's either yes, you believe the market is in a bubble, or no, or C, if you're unsure. If you can spend just a few seconds getting a sense of that. Okay, and that's very interesting. We'll just give it a few more seconds. Okay, so I'm going to end the poll, and we'll see the results. Just to share the results, 24% of you said that we are in a bubble situation. 41% that we said we're not, and 35% said that you're unsure. And that's quite interesting, because yesterday when we we gave the webinar to a predominantly US audience, the answers were reversed. That I think was about 47% said that they felt that we were in a bubble situation, and so it's interesting, the different audience. I think that the US participants in yesterday's webinar were more inclined towards the retail side of things, whereas I think today's more trade related, I think, anyway. So it's an interesting perspective there. But let's tackle the question anyway. So firstly, what is a bubble? A bubble is an economic cycle that is characterized by the rapid escalation of market value, particularly in the price of assets. And this fast inflation is followed by a quick decrease in value or a contraction that is sometimes referred to as a crash or a bubble burst. So I think that first part of that definition, we certainly have seen. We have seen a quick escalation in diamond prices, at least from the lows of last year's COVID crisis. But then the question is if we are setting ourselves up for a quick decrease in value, which would make that a bubble burst. And as I mentioned earlier, this idea has been thrown about over the last month or so, and it's played out quite significantly in the rough market, where we asked the question at the beginning of the month, is there a rough bubble that's brewing? And that really was motivated by another price increase that took effect in the during the De Beers site in early July, and the strong demand that we continue to see in the rough market. And at the same time, in early July, the mining companies reported their interim results for the first half of the year, and they showed very strong sales growth as we expected, and strong price growth as well. And so, including that July increase, which we got that information from site holders, that De Beers wouldn't comment on monthly price increases, although they did say in their half-year results that prices had increased by about 14%, according to their index, in the first half of the year. So add a 5 to 7% increase in July, and we're looking at about a 20% rise in rough prices from the beginning of this year. And that's compared to about an 11% rise in 1 carat polished. So that raised a bit of an alarm bell for us in terms of the rough market, that it was overheating. Boxes were selling at very high premiums on the secondary market, and so demand was still very strong, even though prices were high. So we sounded a bit of a warning bell. But then 2 weeks later, during the Alrosa sale, that trend continued, but at the same time, we started to hear that Alrosa did not have enough goods to fulfill that demand. And so Alrosa went to the market and went to Gokhren, which is the Russian state-owned depository of gems and precious metals. And Alrosa bought goods from Gokhren in order to satisfy that extra demand. So that suggests that there's a supply issue, that if there's a supply shortage, then there isn't enough goods to fill that demand. And therefore that demand and that increase that we've seen lately would be sustainable. At the same time, our sources told us that Alrosa also raised prices by a similar margin, and they had a fairly strong sale at the same time. So we see those sort of conflicting trends. That on the one hand, we're concerned about the rough market overheating, and on the other hand, there isn't enough supply. So the increase should be sustainable. And that's a similar thing that's kind of playing out in the polished market as well. We've seen a really good positive increase since the lows or the depths of the coronavirus crisis, which was really at its low point in April last year. And that's what this graph shows. It shows the RAPI index across various sizes, performance since April 1st last year, 2020. And we've seen the black line is the 1 carat RAPI, which is now up by 26 or 27% since that date. And that's a fairly consistent increase, and it continues even today. We're still seeing that 1 carat consistently on that uptrend. The 30 pointers, which is the blue line, and the half caraters, which is the orange, were a bit more erratic. Maybe there was an initial strong increase, and then it sort of flattened out on the half caraters. Same on the 30 pointers actually, and there's been a bit of an increase and subsequent stabilization in those sizes in recent weeks or months. On the 3 caraters, it's been there was an initial continued downtrend, but then there's been quite a consistent recovery in that. But our main index, which is the flagship index, which is the 1 caraters, has really had a strong recovery since then. And we see that on a quarterly basis, that it's continued in the current third quarter, that we are on track to see our 6th consecutive quarterly increase in the RAPI index for 1 caraters. And that's something we haven't seen in about a decade, since that 2011 increase, and it's very encouraging. It's not something the industry is used to, those positive numbers, as we've seen over the previous 5 years, that it was pretty negative across the board, barring the odd quarter where it went up. And so maybe you could forgive us for thinking that we're in a bubble, because we're not used to these positive numbers. But it's worthwhile at this stage just having a look at the historic performance of RAPI, and maybe drawing some comparison to 2008. Because in 2008 we had a similar decline, or a much steeper decline in polished prices, and then we had a very similar pattern, or a very similar increase in the RAPI index that took effect from 2009, and you see a similar shape until for those first 2 years of recovery to what we've seen so far in the last year and a half. That we've seen this sort of gradual increase and strong, that took effect since April last year. And between January 2009 and January 2011, a similar increase in the RAPI. But then in January 2011, there was this sharp rise in polished prices. And in 2009, the recovery was really driven by an expansion in China. That the Chinese market was growing, and jewelers were opening stores. They were expanding into tier 3, tier 4 cities, and they needed goods to fill those shelves and fill those stores with product. And that's what drove the recovery in 2009. But then the market suddenly became speculative, that the midstream felt that this Chinese demand was going to continue indefinitely and became a speculative market. And that's definitely a bubble, where we see in January 2011 to about August 2011, there was this just continued increase, and very sharp increase, that proved to be unsustainable, and became unsustainable, particularly when the Chinese market started to slow down. Premier Xi Jinping came to power around that time, and he started to implement his anti-corruption campaign, which affected luxury demand, among other reasons, and the bubble burst, and we saw a consistent decline in prices ever since then, until the coronavirus crisis brought a sharp decline in March, and then we've started this recovery again. But it's just interesting that this pattern is very similar, and so the question is, are we going to see this sharp increase again that will really prove unsustainable? And my feeling is no. There's no reason or no indication in the market that we're going to have that sort of level of speculation that we saw in 2009, or 2011 rather. So then the question is if this increase, this gradual increase in recovery, is sustainable, and what sort of pattern we're going to see from here on in. I think the difference between 2009 and 2020, and we'll get into it a bit more later on in the webinar, is that demand seems to be more sustainable this time around. Is that this has been very much a US recovery, and the US market is a much more mature market than China, as we know. And so we are seeing at the moment phenomenal jewelry sales growth that is driving in the United States, that is driving this recovery and filtering through to those polished prices. And that's a much more healthy recovery that we're seeing this time around, I think. Just to throw a few numbers out there, the Mastercard Spending Pulse, which monitors the jewelry sales on Mastercard systems, but also on a wider scale as well on other platforms also. They reported, in July, 82% increase in jewelry sales compared to last year, which we would expect considering the state of the market at this time last year. But also compared to 2 years ago, the numbers are quite impressive. 54% rise compared to 2019 in July, 59% increase in June, 44% in May, etc. They didn't always give those 2-year comparisons, but we're seeing pretty strong numbers even still today in the latest numbers. So that's very encouraging, and we're seeing those sort of positive numbers also in the major jewelers. Signet report is showing 98% increase in revenue compared to last year, and about 18% compared to 2 years ago, and really the numbers they reported in their first quarter for the fiscal year, which ended, I think, the 3 months ending end of May, I think it was their strongest first quarter in at least 5 years. So again, very encouraging and feeding into that positive sentiment that we've been feeling lately in the market, and also feeding into the narrative that this is not a bubble, that this improvement is sustainable, because jewelers are selling jewelry, and that's a good thing. The other thing is that China has also come back quite nicely. It's got a smaller share of the jewelry market, but we're seeing positive reports out of mainland China, at least. Chow Fook, which is the biggest jeweler in the region, has showed 43% year-on-year growth in its June quarter, and really has shown positive numbers pretty much throughout, except during that period of the coronavirus crisis, which hit China first. And so that was October to December 2020, showed a 50% decline, subsequently 11%. But then we've seen positive growth in mainland China. And also we're starting to see some growth in Hong Kong from Chow Fook, albeit, which is the orange bar graph, albeit against fairly weak numbers that we've seen in Hong Kong for the last number of years. So it's coming off a low base, and maybe we would expect some positive numbers in Hong Kong. But certainly the China story is encouraging as well. And it's not just these majors, other jewelers. Our news feed on the retail side has been fairly consistently positive on diamonds.net, and these are some of the headlines that we've run in the last month. LVMH buoyed by resurgent jewelry sales. LVMH, of course, now reporting with Tiffany as part of its portfolio. Outstanding jewelry sales at Richmond. Luke Fook sees a sales rise in its first quarter. They're Hong Kong, China based. Profit bounces back at Indian jeweler Titan, which is Titan being one of the bigger branded jewelry companies in India. And Chow expects profit surge. And just anecdotally, we also hearing from the American independents that they're seeing some good numbers. So it's not just the big companies. It seems fairly positive across the board on the retail side. And that may be just an initial sort of maybe that's a knee-jerk bounce back from the lows of last year, or that we're still having this moment where people want to give emotionally charged gifts to their loved ones after all we've been through in the last year and a half, or that they have more to spend from the lack of travel, etc. Whatever it is, jewelry is doing fairly well, and certainly is in a positive trend that I haven't seen for some time. And that's trickling down to the midstream, that the manufacturers and dealers are seeing good activity. Jewelers sell and they need to replenish inventory that they've sold, and so they go to the market, and that stimulates activity amongst dealers who look for goods to fill orders, and manufacturers who need to buy more rough to produce more polished to fill those orders as well. So that's all very encouraging, and we're seeing it in the numbers as well. The United States, which is the biggest importer of polished, is seeing numbers that are similar to pre-COVID downturn. So in the first and second quarter, we're seeing back to sort of those normalized numbers as far as the US imports are concerned. And India's exports being the major manufacturing center, India imports rough in order to manufacture polished and exports it to markets like the United States, Hong Kong and China and elsewhere, the United States being probably its main market. But we are seeing really strong recovery in exports from India of polished that are again back at pre-COVID levels, and in fact exceeding pre-COVID levels even. And so that again shows that the market is back working. It's back. There has been some form of recovery and signaling that there is demand out there and people are filling orders. Okay, and so that's really the demand side of the market. And so now let's look at the at the supply side, because the supply side is fairly interesting, I think, and not so easy to. It's not so clear cut and easy to understand. What we're seeing on RapNet in terms of polished supply that's coming to the market is that we've seen a fairly a consistent rise in the number of diamonds on RapNet. We're now back to over 1.5 million stones that are listed by suppliers on RapNet, which is back at pre-COVID levels. A lot of goods were taken off RapNet when the COVID crisis initially hit. But we've seen that that a lot of sellers have come back onto the system, and a lot of goods have come back onto the system as well. And particularly in the last month or two, we've seen a steady rise in goods on RapNet, and that shows, among other things, it shows that manufacturers have more goods to sell. They brought more goods bringing more goods to the market, and they're looking for buyers. But at the same time, it's as we've said, that some prices have continued to rise, and that's a bit of an anomaly for me, because when supply goes up, you would expect that prices would soften. So it suggests that demand is exceeding supply still in some way. But if we compare the number of stones on RapNet in the 1 carat category and the average price of those goods, we see that the orange line, that prices have come up fairly consistently, as we've mentioned. The number of the inventory on RapNet has been up and down a bit over the last year, but certainly in the last few months, we've seen that same sort of rise in inventory, which has been accompanied by an increase in pricing. And again, that requires a bit more research and understand what exactly is going on. I'll present a few theories in the coming slides, but let's first look at the half carats. A similar story over the last few months: a rise in the number of stones in the blue line, and a rise in prices as well in the orange line for those half carats. It's flattened off a bit in the last few weeks, but that same trend of up and up is evident there. And similarly, on the 30 pointers, the number of stones on RapNet are a bit erratic. 1 or 2 suppliers take stones off and bring them back on, but the general trend is the same. The general trend is up. The blue line showing an increase in the number of 30 pointers being listed on RapNet, particularly in the last few months, and the general trend of prices has been positive, with some stabilization in the last month or so. So why are prices rising with inventory? If more goods are becoming available, that should put a bit more leeway or leverage on the buyers, who could then sort of have more options of where to buy, among other things. So I'm just presenting a few theories. It's something that we've discussed internally, and we're not 100% sure why that would be the case, but we can just present what we see in the market. And the first question would be, maybe it's a bubble. Maybe this is a sign that that prices are rising regardless of what's happening in the market. And that's a question mark. It's, again, I'm not suggesting that it is the case, but it's a question mark. Why are prices rising while supply is rising as well? Maybe it's a bubble. Another theory may be that more goods are coming to the market after strong rough buying in the first half of the year, and there is demand to support it. So good luck to the market. There's if there's shortages in the market, there needs to be and more goods come to the market, means that there is demand to fulfill that supply. And it's just worth mentioning as well that throughout the year, we've seen this sort of backlog in supply within the supply chain on the polished level. Rough is coming to the market. We know that there's been a lot of rough buying out there from the fourth quarter of last year through to today. And that would indicate that manufacturers are manufacturing goods. But not all the goods have been able to come so freely to the market. We know that the GIA has had a backlog of goods being submitted for grading. Their turnaround time in their India labs is still about 5 weeks, and that's a source of frustration for, I think, a lot of suppliers. But that's a reality. And so, but slowly, but goods are coming to the market. It's a backlog of 5 weeks, but the GIA is steadily releasing goods. Another reason why prices are rising with inventory, or is that inventory might be rising because there is a bit of a slowdown. There's a seasonal aspect to diamond trading and diamond demand. And during the summer months in the Northern Hemisphere, July, August, we know that a lot of people take vacation. And so not as many orders are being fulfilled as before. And so that would suggest that that inventory is rising because not as many goods are being sold, even though they may, but it doesn't necessarily suggest that there's a decline in demand because just the market is on vacation, or parts of the market is on vacation. And I'll show you a slide that may suggest that as well. But first, before we get to that, why are prices still so strong? Another aspect is that rough prices are strong. So manufacturers can't reduce their polished prices because they've paid so much for their rough, and they need to protect their margins by doing that. So there is an argument to say that even though inventory is rising, suppliers need to maintain a certain level of polished prices because of the costs that they've laid out for rough. Okay, so just to get back to that inventory rising due to seasonal slowdown, this is a graph that was formulated from or taken really from our research report that went out last week, our monthly Rapaport research report, which shows the number of diamonds taken off RapNet in June, which is the latest month that we have full data for this metric. When a diamond is taken off RapNet for a number of reasons, but generally when it doesn't reappear on RapNet within the next month or two, we assume that it's been sold, and that's why we wait. There's a bit of a lag that the latest data is for June, because we want to see if that diamond reappears on RapNet in July or August. But the number of stones off RapNet in June compared to the average of the previous 3 months was down in pretty much all categories. As size categories and quality categories, you can see that it's a negative figure for all of them, in fact. And so that suggests that there is a bit of a seasonal slowdown, that the first quarter, the second quarter are fairly stronger trading months, and then people take sort of a vacation around the summer, or things slow down a bit because retailers have the stock that they've replenished in that first half of the year, and then things start to pick up again when they start to prepare for the holiday season. But as sales would have slowed in the last month or two, And it's really a relative thing. This is not that the market is slow, but the market is slow relative to the first half of the year. Less goods are being sold, and so more goods are becoming available, particularly as manufacturers have raised their polish production. And so it would be natural that that polished inventory levels would go up at this time. Just on this fourth point about polished prices being upheld by rough prices, we see the increase in rough prices in 2021. That we've spoken at length about the gap between polished and rough prices over the years, and how that really represents a tight manufacturing profit margin. But over the last year, since the depth of the coronavirus economic crisis, we saw that polished prices came back sooner than rough prices, and that was the case also, by the way, in 2009. If you look over here, that the black line is the polished, and the recovery preceded the rough market recovery, but the rough market then overtook and increased by more, and came down by less, frankly. And we're seeing that starting to happen now, because rough prices have came back a bit later than the polished in 2020, but have increased by a steeper margin. And so that gap again is widening. As I mentioned earlier, we estimate that rough prices are up about 20% in 2021, versus the RAPI index for 1 carat as polished prices up by about 11%. So that's something to keep an eye on, and also again feeds into that narrative that manufacturers need to protect their profit margins, and so are keeping polished prices at a certain level because they can't reduce because of their layout on the rough. So moving along the supply story, and we get to the rough market. And the rough market has, as I've mentioned a few times already in this webinar, has been fairly strong in the last year. Certainly in the first half of this year, we see that India's rough imports that they're bringing in for manufacturing has spiked in the first half of the year, and was really at a near record. The only period to exceed this year's period was in 2017, when a lot of goods came to the market because of new mines that had been launched, and that created an oversupply situation. But here we are correcting from these lows of the first half of last year, but there has been strong sales, as we see, or strong buying in this context in the last year, both in the second half of last year and the first half of this year, and continuing into July, as we mentioned earlier. And that's reflected in the sales of De Beers and Alrosa, which are the two main mining companies, that in the last few quarters they've seen a spike. Certainly in that first quarter, the value of rough sales was the highest that we've seen it in a long time for a quarter, being the combined sales of these two companies. And that actually came down a bit. It normalized somewhat in the second quarter. We continued to report about strong demand for it, but actually less quantities came to the market in the second quarter. But if we look at it as a whole, over the last 3 quarters, there's been a lot of rough that's come to the markets. The bar graphs being the volume, the number of carats that are out there that they sold, and the line graph being the value of those goods. And so as we've seen a lot of rough coming to the market, we should expect more polish to come to the market in the second half of the year, particularly as we've spoken about that supply glut, or those delays in the supply chain, particularly at the GIA in India, that still continues to have that. I know a lot of people don't like the term bottleneck, but I have that in my mind, and it's what this illustration depicts. But that's what seems to be happening, is that there is a volume of polish in the system that's waiting to be released to the market. We did speak about in previous webinars a concern about those goods being sort of dumped on the market, being just suddenly arriving on the market. I don't think that's going to happen. I don't see it happening now. I think GIA, even though it's on this 5-week sort of turnaround time, which is long, it should be maximum 2 weeks. I think they will steadily release those goods and steadily reduce that turnaround time as the market adjusts. But I don't expect just I think the increase in inventory as a result of those goods being released will be more gradual. Just from a mining point of view, the mining companies are selling everything they have. In other words, they're selling all their production, and that we know that in 2020, when the market shut down, they built up a lot of inventory. But this graph shows that they've sold off most of that inventory. So if you look at a mining company producing diamonds and selling diamonds, whatever's left would be the inventory that they're holding. It's not an exact science, so I wouldn't. It's not an exact science, but this definitely shows it provides a strong indication that in the last three quarters of data that we have available, the fourth quarter of 2020 through the second quarter of 2021, the mining companies sold more carats than they produced, by this margin over here. And so they've reduced any inventory that they built up in 2020. And we know now, as we saw in that Alrosa story earlier, towards the end of July, that they are selling everything. They're selling what they produce. So any production that comes to the market, and I think this is true for all the diamond companies, frankly, including De Beers, that the mining companies anything that they produce, they're selling off to the market. And that's a healthy situation, I think, to be in. I think that's probably the way it should be, that you don't want the mining companies to build inventory. You don't want them to hold inventory at all. But it also suggests that production levels have leveled off, and production fell in 2020 to new lows in the context of the last decade or two, that I believe will be maintained at around these levels. According to my calculations, the volume of rough that is being produced in 2021 is about 3 or 4% below that of 2020. But the value of those goods will go up because of the increase in prices, probably by about, if you look at it by value, it'll probably rise by about 15%. But in terms of the carats that are coming out of the ground, I think for the medium to long term, we're looking at a supply situation where the mining companies will not have the rough the volume of rough that they used to have in the last years. And so that's influencing a lot of what's going on in the market now, I think. and what will go on in the markets in the future. Because if you think of those prices rising, prices rise when demand increases or supply decreases, and we certainly are seeing a scenario that frankly the industry has been foreseeing for some time, but never really believed because of the short-term situations we were always in, that in the long term it looks like there is that long-term supply shortage that is starting to play out. And if we look at this year, and I presented this graph back in January, where we consider the number of the value of rough that's required, or the volume of rough that's required to satisfy jewelry demand or jewelry sales. And you know, by De Beers estimates, jewelry sales were at about you know, just under $80 billion in 2019. They've come down substantially. I think I forget the exact estimate in 2020. And similarly, we've seen a decline in rough production as well. And so what's going to happen in 2021, where we've seen a strong recovery in jewelry sales, and we would expect it to come back to at least around 75 billion, if not exceeding those 2019 numbers, which was a peak for the industry. And yet we are working off lower production levels. And so if you take the ratio of what's required, what rough is required to fill jewelry demand, it's usually at around 18%. But last year it fell to about 14%, and it looks like it's going to stay at that level in 2021. And that suggests that there is less, that the industry is using less diamonds to fulfill more demand, and that would feed into the thesis that when we ask the question, is there a bubble that the market is in, that would feed into the thesis that there's not, because less goods to fulfill more demand is kind of where we want to be in terms of growth in the industry, or you know, and it certainly supports a thesis that the increases that we've seen in 2021 are sustainable, or may be sustainable. So when we look back, and so that's the bubble question. You know, there are cases to say that that there's in the short term there's a supply glut, and there's more goods that will come to the market. And the question is that if that growth in demand will continue to the same extent that we've seen it. And then on the other hand, and we're seeing that prices are rising as inventory is rising, and that all suggests that maybe it's not sustainable. But then we look at the supply side of things, and compared to the demand that we're seeing, and it seems that it is sustainable. So again, I'm just presenting scenarios here, and I leave it to you to come to your own conclusions. But I do want to spend a few minutes before I open up for questions, just looking at our crises that we've gone through in the last decade or two. There was 2008 to 2009 financial crisis, and then there was the coronavirus crisis, and all sorts of prolonged mini crises that were diamond related in the interim. But I want to focus on those two macro crises and what we can learn from them. The first, or how we can compare them, how do they differ? The first easy comparison is that 2008 and 2009 was a financial crisis. It was economic, whereas 2020 was a health crisis. And while there was deep concern about the impact that it would have on the economy, and it certainly did have some impact on the economy, ultimately the economy bounced back quite quickly. It adjusted. the business community adapted to a new way of doing business. It was a pivot to digital, as they say. That a necessity is the mother of all invention, or maybe it's the mother of all innovation, because the level of innovation we've seen in the business community and also in the diamond and jewelry industry over the last year, I think, has been unprecedented. But the point is that business carried on, and the second point is that people did okay financially. Of course, there were many who lost their jobs, and our heart goes out to them, and everyone should come back to good times. But in terms of the core American diamond and jewelry consumer, they did okay, and in fact more than okay. They were able to save more. They were willing to spend more on discretionary items such as jewelry. And so the business side of the jewelry industry actually wasn't affected as much as in the 2008 crisis. And I think the core reason for that is that in 2008 was really an American crisis. It was an American downturn. And so the second aspect, or the second way to compare these two crises, is in terms of the effect that it had on industry efficiencies. That in 2000, and I'm going to run you through the last decade in one slide here, the way I see the market, how the market developed. That in 2008, retailers recognized the risk in holding inventory. The market crashed, and they were left with all these goods in their stores that they didn't know, they couldn't sell, they couldn't move, and they realized that they didn't need to bear that risk. They could hold less goods in their stores and not necessarily be exposed in that same manner if in the event of a future crisis. Technology enabled faster order fulfillment for retailers in the interim as they reduced their inventory. Technology came into play, and more goods were also taken on memo, which enabled retailers to hold goods and not own them until they sold. And it's a similar story. The boom in online trading within the industry meant that retailers had access to more goods in real time. They could go onto a platform like RapNet, look for goods, and in terms of global shipping and global orders and the way to do business remotely, even before, or well before the COVID crisis, it became much easier and quicker to do so. And so again, they could order goods in real time and not necessarily hold them in the store. Meanwhile, the midstream, that meant that the midstream had to hold the inventory. They had to have the goods to send out on memo, or they had to have the goods to be able to fill that order in real time if a retailer contacted them. So the midstream took on the inventory risk, midstream being dealers and manufacturers. And that means they needed more goods. And the miners took the opportunity, I say cynically, the miners pushed more rough to manufacturers, and frankly, manufacturers were prepared to buy those goods even at higher rough prices. Meanwhile, the banks reduced their lending to the industry, and the trade learned how to self-finance more of that inventory that they were buying up. So they were being trained to rely less on the banks. And at the same time, there was an investment in technology innovation by service providers such as Sarin, the GIA, De Beers, Sonova is another that comes to mind, and many others that stimulated the drive to modernize old systems and ways of doing business. And so in terms of this slide, we're thinking about how the market slowly became or was being pushed towards more efficient market and is still being pushed in that manner. But technology started to really play a role in the last decade, between crises, should we say. And then, of course, COVID happened, and there was this accelerated pivot towards digital on all levels, be it from a mining company in the way they sold rough. They had to do it digitally in many cases, certainly in online polish trading, and certainly in at the retail level, selling to consumers with more of a online emphasis. This next point has been developing over the years. It's not necessarily in chronological order here, but there has been an increased awareness of ESG factors. ESG stands for environmental, social, and governance factors. And so sustainability issues have become more important to the industry. And this has resulted in a more transparent supply chain. So again, when we're thinking about efficiencies, that companies need to and are willing to be more transparent in who they do business with, how they do business, to show that their goods are sustainably sourced, results in a more efficient market. And then finally, the lower rough production, going back to our previous point, means that the industry must manage with less rough to full growing demand. And that's why I think you're hearing the mining companies are stressing in their messaging that the industry needs to be more efficient, that there needs to be a more efficient supply chain. And it's not something we've heard over the years on a consistent level from the major mining companies, but we are hearing that messaging now, because the industry needs to be more efficient, because it needs to make do with less supply for more demand. And that's just, and so when we think about the difference between 2008 and 2020, 2008 was a retail shift to efficient inventory management, and the industry didn't play along with that, didn't take its cues from the retail market. Slowly, it's been forced to do that, and 2020 is seeing a drive towards efficiency across the entire supply chain. And the other difference between the two crises, and there's just one more slide after this, and then I'll open to questions, is the first, as we mentioned earlier, 2008 was a China crisis, and the 2008 was the recovery from 2008 was driven by China, and it was an expanding emerging market with which stimulated a speculative industry. And 2020's recovery is really being driven by the United States. The United States is a more mature market, which means that the recovery in US jewelry sales is more sustainable. And in addition to that, we do still have China, and China itself is now more mature, and so is making a more stable contribution, as we've seen a recovery also in China from the COVID situation. And so that again is more of a gives us more confidence that the recovery is sustainable. And finally, we've got to look at consumer habits. What's happened over the last decade from 2008 compared to 2020. 2008, and both crises represented a bit of a generational shift, if you may, but where in 2008 millennials really came through as the emerging generation that was going to be the core engagement ring customer. They were the ones who were coming into new high wealth positions. And now we're seeing that generational shift again, where we're hearing more about Gen Zs who are taking those positions, coming into the job market, starting to get engaged. And the good news is that we have both. We have the millennials and two high earning potential generations that are going to be buying diamond jewelry. And of course, we shouldn't forget the Gen Xers and baby boomers who are also there supporting the market. There's been a dramatic change over the last, forget about COVID, but just over the last, if you compare where we were 2008 to 2020 in how we consume and the level to which we consume, forget about buying products online. It's where you consume your information that counts. And jewelers in 2020 have realized that it's information that sells, that is the selling tool. And so it doesn't matter where that final product is sold, whether it's online or in the store. The initial engagement and sales process and relationship with your consumer is really taking place online. And so that makes omni-channel platforms much more important. Whereas 2008, I think we were, if stores had closed down or had to shut in 2008 because, if the way they did last year, they didn't have that same option to the same extent as we do today in terms of omni-channel. Today's consumer has a desire to be different and unique. Social media, which has grown exponentially over the last decade, has really brought out sort of a culture of trying to show who you are and standing out from the crowd, and that's and there's a desire to be different. Whereas we were maybe a way to put it is that we were more generic in our thinking and in our actions in 2008. Today there's such immediate information and ability to show what's happening in one's life that there is a need to be different, and that's resulting in more bespoke jewelry, more customization, and a greater emphasis on storytelling. How does a jewelry company or diamond company tell their story so that the customer can relate to it on a personal level that's unique to them? And that's the challenge of brands and companies across the industry. And then finally, I think we're dealing with a broader market that we have the traditional bridal market that's always been there. Female self-purchases increased between 2008 and 2020. Gifting was, the industry had a moment about gifting in 2020. We're also seeing more men's jewelry trending. And there's, as Gen Zs come up as the social influencers, there's more of an emphasis on gender neutrality, and the LGBTQ community is becoming an important source of jewelry sales and a good community to buy. And whereas if you think about 2008, gay marriage wasn't legalized in the United States. Today, it's not even a question. It's not even a question, and that's a good thing. And there are different other communities that are coming up as important potential jewelry customers. The Hispanic communities got great potential, as does the BIPOC community. And then finally, we compare the two crises in terms of the industry's marketing capability. In 2008, De Beers has just ended its generic marketing spend, moving to branding as it was well entitled to do. And it took a while before the industry adopted a generic campaign, and the Natural Diamond Council was rebranded in June last year, and it's embarked on campaigns that are much more fresh and much more up to date and relevant to today's consumer. For this year, they're looking at they've come out with a style guide where they are pushing certain trends in the market, and that's depicted in this slide. Marquise is an emerging trend for engagement rings. heavy metal chains, hoop earrings, diamonds and pearls is another trend that they're going to be pushing in their messaging, and also looking for the industry to come on board with that messaging. And in terms of what's being pushed for the holiday season, I think they've re-signed Ana de Armas, who's going to be featuring as the next in the next Bond movie that comes out around the same time that the Natural Diamond Council launches its campaign. And so it feels like there is marketing initiative, not only from the NDC, but also we're seeing a similar sort of fresh, interesting brand messaging amongst the larger jewelry companies. And it's really up to the rest of the industry to get on board. So when we ask ourselves if there's a bubble or not, if the increase and improvement in the market is sustainable or not, maybe the correct answer to that question is it depends. It depends how the industry approaches the next 6 months and beyond, that it can be proactive to push its product and engage with consumers in the correct way. And so I'll leave you with that thought. Thank you so much. I know I went over time a little bit, and I apologize again. I tend to do that, but I appreciate your time, and I'm happy to take a few questions before we wrap it up.